Rob. Wow. So that is great. So, well, happy Friday, everyone. This is the Rundown with Rob and Rich, where we take you into the weekend by rolling through the week that was in the mortgage industry every Friday at 3 p.m. Eastern. And as always, pleased to be joined by my esteemed colleague, world traveler, Rob Chrisman. Rob, good to see you. Holding on to the necktie. I love the commitment to the necktie.
Well, somebody's got to class this show up, Rich.
It's not. You might Cleveland Indians.
Did Rich freeze or did I freeze?
22
It's Rich, Rob.
2026.
Oh, Rich froze? Oh my gosh. Peace and quiet. Oh, here he's back. Never mind. Oh,
right.
We missed you, Rich. We missed you.
So, okay. I was just saying FHFA came out with their strategic plan for the next 5 years, and not a lot of surprises in there. A lot of stuff that Sandra T and others have been talking about, but went through it, Rob, and read the entire thing today, made a bunch of notes. I'm guessing you didn't read through the entire.
No, I did. I went to the Tenement Museum, Lower East Side, this morning, and then came back and read a good chunk of it. And I think, Rich, I'm going to be cynical here, so maybe you should tell the group, tell folks what you got out of it, because I'm going to be cynical.
Okay.
Go ahead.
Oh, you want me to? Okay, yeah. I mean, not a lot of surprises in there. Obviously, things we knew we'd see in there: fair lending assessments and compliance. I was pleased to see in print a strong commitment to keeping a level playing field through pricing for large lenders and small lenders. I think that's vital, just especially our members, but the mortgage market as a whole. Some things that were in there that were intriguing to me. Leveraging a strong focus on leveraging technology to promote efficiency and cost savings, really talking about lowering the cost to originate down in any way they can through technology, using desktop appraisals as one example that they laid out, a first path there. A lot of talk about that climate change impact, which caught me off guard. But some pieces talking about how climate change really affects the underserved and the affordable housing stock, much more than any other part of housing, and hurricanes and all the crazy fires you've got out in California and floods, and how that could really further impact low to moderate income borrowers and people living in affordable housing. And talking about FHFA data products, it seems like that, all this HMDA data that they've been now collecting, the expanded set for some years, it feels like they're on the cusp of weaponizing some of that data. One, I think to hold lenders accountable to fair lending standards, but two, I think is a way to put some thought leadership informational stuff out there that in theory could help some mortgage lenders in different ways. But it was, no big surprises. What did you take out of it?
So I think that you nailed it. So hats off to you for summing it up so well. I read a chunk of it and I thought, this is just government bureaucracy at work. And I think that you really did a good job there of picking out the strong points. And I think those are the things. Sorry. Those are good things for the listeners and the industry in general to have noticed. I know that when Sandra came to speak at the Mortgage Collaborative event in Miami, I heard technology being discussed, and I pulled her aside, frankly, and I said, Sandra, baby. No, I didn't say that. No, I think that her experience with GMC and with other lenders that are out there showed I think a little bit of a shift towards technology, and there is so much data that the FHFA and Fannie Mae and Freddie Mac have that is of value. So, and it's nice to use information in terms of doing something constructive rather than, let's say, the CFPB using other information that might not be so constructive or might be used to uh, negatively impact a given lender. So to see that shift and be able to use that information, I think is very, very important. But I thought you summed it up really, really well. So good job.
Yeah. And, I think something else that was in there was a written and stated desire and commitment to elicit the opinion of decision makers in the real estate finance industry, which I thought was great. They talked about wanting to host roundtables and be at events like ours where they can get in front of and get the message out to mortgage lenders and do what Sandra T did with our lender board of directors and sat and had breakfast with us. And literally for like an hour and 15 minutes was just very eagerly, wanting to hear from CEOs of mortgage companies and leaders in the industry on their thoughts on a lot of these things. And another part of it, the last page of it, talked to some of the challenges and risks to executing this business plan. Some things in there that caught me off guard: the supply issue and their lack of ability to control it. That not surprising, obviously. But the climate change and the climate impact thing was in there again. And also something that I really didn't think of, but is true and valid. And they spoke to the likelihood of very slow prepay speeds because of the rate climate and the loans that are on the books, and how that lowers net amortization fees, and how those types of climates lead to more credit losses. So something that the GSEs have to consider, being under government conservatorship, all these loans, that they're servicing and holding and, have, they're going to be on the books for a long time. A lot of them are moved and sold, but there's the servicing piece of it and things like that. So I thought that was another interesting piece. So
Yeah, I agree. I correspond regularly every time I put something about climate change in my commentary, and I believe that the climate is changing, whether it's man-made or natural, doesn't matter. It's changing, but every time I mention that in my commentary, I receive emails from telling me I'm all wet, for to use a polite term. But I always respond, whether or not you believe in it, investors believe in it. And when investors believe in it and decision makers believe in it, and it's impacting their bottom line or the bottom line of shareholders, then it's going to impact us. And when it impacts us, it's going to impact borrowers. So whether or not you believe in climate change, I don't care. Other people do, and it's impacting the pricing of insurance. It's impacting the pricing of mortgage-backed securities, of servicing, of all kinds of things, loan level price adjustments. So, just get used to it, and you're going to have to deal with it. So whether you believe in it or not.
Well, America had never been more polarized ever. It's crazy. Like, it's because you put anything out there, any kind of opinion on anything, and climate change or any issue, it's like you can't. One of my general philosophies in life is always to try to avoid extremes, right? To see both sides, to be in the middle. You don't watch Fox News, you don't watch MSNBC. You try to find something that is in the middle. You try not to just have opinions that are one way regardless, but the country we live in, a bunch of different factors really has kind of gone the other way. So
I know. I mean, I just bought this tie here in Manhattan, doing some updating of my wardrobe while I'm here. I'm sure I'll get hundreds of emails saying they don't like the tie. But anyway, that aside.
Speaking of trying to live your life in the middle and to be in the middle, the regulatory climate in the mortgage industry, never in the middle. Either there's no regulation or there's insane, terrifying amounts of regulation. And, those that are terrified, more ammo for that. Not in as much that CFPB filed a lawsuit against TransUnion. It seems like what they're suing them for is probably true and probably has validity and is probably worthwhile of a lawsuit. But the language they issued a press release bragging that they were suing TransUnion, went on to call them an out of control repeat offender that was unwilling or incapable of operating lawfully while participating in dark and deceptive practices. Katie Klaus from People's Mortgage was my co-host on Last Week in Mortgage Today on Tuesday. She's like, it was reading like something like from a Sith Lord from Star Wars, the language that was in this press release. He's really trying to make a point, you know? And I love anytime that there's a CFPB column, they find these just angry pictures of Chopra where he looks like he's like gritting his teeth and, you know, that he's just about to like kick a random mortgage CEO in the nuts.
That's kind of a sexist statement, Rich, but we'll let it go. The thing about the TransUnion case, and you're right, I mean, the verbiage about unwilling or incapable of, I think we should all start using that with our relatives, our children. You know, are you unwilling or incapable of cleaning your room or eating your vegetables, whatever it might be? The responses that I saw from folks out there, maybe I'm sure it wasn't a random sample, but the thinking was, and I have a letter in my commentary tomorrow that summed it up pretty nicely, that until Congress can do something about this whole credit process, you know, who owns their credit information? Who, you know, should it be turned over to a credit bureau? What role do credit rating agencies play in this? Can borrowers, should they own their own data? And so when asked to divulge it, to have a loan approved, should they be the ones doing that? How should it work? And Congress, you know, especially the Senate, you know, where the average age is 88 and they don't even know what a credit report is, to ask Congress to do anything remains to be seen. So this letter, the writer of this letter was saying that maybe the CFPB is in the best position to deal with some of these irregularities and some of these problems in the credit reporting space. Now, I don't mean to single out, you know, the credit bureaus or the credit reporting agencies, but, you know, it's similar to what we see in the appraisal business. I receive letters all the time about when are we going to fix the appraisal process? You know, my son just graduated with a degree in whatever, and you know, he's not going to become an appraiser because he doesn't want to be an apprentice for a couple of years. Again, somebody who's going to compete with him, so forth. The credit world is probably something else that needs to be taken care of, or at least examined. And I think, as this writer pointed out, maybe the CFPB is in a good position to do it.
Yeah, so it's just the rhetoric, you know, like there's a lot of good in what they're doing. And you know me, I joke all the time about Chopra, but I'm a big believer that especially our members, they need a strong CFPB, much more at risk with one that's not watching the biggest lenders in America. And but it just seems like the rhetoric is a little unnecessary. And it creates this, like, you know, the regulatory community should want to work with the lending community. And he's not making these comments about the lending community, but it impacts, you know, people like me making jokes about it. It just, you know, not necessary in my opinion. But
yeah, we don't know. And I mean, I don't know, maybe you know, or maybe people in the credit business know. Maybe TransUnion is especially especially bad, or they want to make an example of TransUnion. We don't know what was going on behind the scenes because it looked like it had been going on a number of years. And so we don't know what was going on to lead the CFPB to lash out like that, because lash out, they certainly did.
Yeah. This is the Rundown with Rob and Rich. I'm Rich Swarinski with the Mortgage Collaborative, joined as always by Rob Krisman. And we've been talking about rates a lot, but it continues to be a big story in the industry. The 10-year at a new high, 2.8. Who would have thought that the 30-year fixed rate would be 200 basis points higher than United Wholesale stock price? I mean, who would have predicted that one?
Aren't you going to say, Rob, your boy Matt?
Yeah, you guys go to McDonald's to get lunch all the time, right? So it's just, it's crazy. I mean, you got 30-year fixed rates, 5.5 for a lot of people right now.
You know, let me just say this about United Wholesale, Rich. Hang on here. Let me just say this about UWM. I'm looking up there through the magic of my smartphone. If you were to buy United Wholesale stock, you could earn a 10.3% dividend. So 10.3% dividend at United Wholesale. But when you look at all the public companies, you know, Loan Depot, whatever, Home Point, they're all down quite a bit. But so getting back to what you were talking about. So I didn't mean to interrupt. Go ahead.
Yeah, it's just no real question. Was just making note that the 10 years at a new high this year,
Right.
282, 5-year 279. It's yeah, I mean,
Yeah, I think the point I try to make to audiences is that it's not the fact that the rates have gone up necessarily, because we all knew.
ooh,
Oh, I'm near the subway. Can you tell? Uh, oh boy. Uh, break into my Rodney Dangerfield routine. But anyway, we all knew rates were going to go up, and we all knew deep down inside that 30-year rates weren't going to be in the twos forever. So rates have gone up. I think what has surprised the industry is the speed at which rates have gone up. And it's almost kind of this knee-jerk reaction. It's the fact, as you pointed out a number of times, the Federal Reserve is trying to play catch up, and they basically dropped the ball. And that's the feeling that I get out there, the feeling among my investment banker friends, that it's a big game of catch up now. And the Fed presidents are going to be out there speaking and talking about raising this much or that much and this much and that much. The fact of the matter is, inflation is out of control at this point, and the Federal Reserve, whose job it is to help promote economic stability in the United States, having a 7 or 8 or 9% inflation rate is not economic stability. So what are they going to do about it? And so raising rates obviously is part of that, because when you raise rates, it makes economic decisions more difficult to actually execute. And the example that I give folks is that if you are a family in an apartment, and I know I've used the traditional family in the apartment example many times, but if it at 2 3/4 and your rent is $2,000 a month, and at 2 3/4 you can get your monthly payment is only $1,700, it's going to be easier to pull that trigger than if rates were at 5.5% and your monthly payment has gone up to $2,300 and your rent is $2,000. You still want to own a home, but it's not quite that economic. It's not so straightforward economically, and it's more of a sales job for a loan officer to say, well, here's why you're better off at $2,300 than $2,000. The rates have gone up. We knew rates were going to go up. The speed that they went up is what caught a lot of people off guard. And so now we're playing catch up. And I'll tell you, Rich, I think that I speak for a lot of folks out there. The situation is pretty dire in terms of companies and loan officers who have based their business on refis. If you were doing 70, 80, 90% refis over the last couple of years, you had a good couple of years, and I hope you saved your money, and I hope you didn't invest it in publicly held mortgage stocks, because that's gone away. But if you are a lender or a originator who has continued to foster relationships with realtors, with financial planners, with divorce attorneys, with remodeling companies, with contractors, et cetera, et cetera, et cetera, that's where things are going to benefit you at the expense of some of your competitors out there. So it's a changed environment. I'm getting a lot of emails saying, boy, I don't know if I'm going to make it, that kind of thing. And that's primarily from originators, Rich. It's not so much from lenders. Lenders are cutting back as fast as they can, I think, and trying to make their originators more efficient and their ops staff more efficient. But it's almost like the Fed. A lot of folks are almost playing catch up at this point in terms of efficiency and in terms of continuing to make their margins. It's tough out there. It's a very tough environment, and we're gonna see a lot of shakeout, I think, this year.
Yeah, absolutely. Yeah. And byproduct of the run up in rates that you just alluded to, ARMs making a comeback. We've been talking about this most recent MBA application survey. 7.5% of all new apps on adjustable rate mortgages. I've talked to some of our members this week saying 15-20% of new apps this week on ARMs. I tell you right now, if you're a mortgage lender and you just have access to Fannie, Freddie, and conventional and standard Govy outlets, Make that a priority right now, trying to find good outlets in the secondary market, if it's adjustable rate product or other products that are going to become a bigger piece of the pie as we get into the year. Because at 5.5, 30-year fixed rate, and ARM should be, it's very viable. Very 3-5 year ARM, way people move around.
I think one of the issues with the ARM market right now is that the investor interest in ARMs or in mortgage-backed securities backed by adjustable rate mortgages is limited at best, nil at worst. But the ARM pricing, when you talk about 7.5, 8% of the apps being adjustable rate mortgage apps, I think a lot of those are going to financial institutions, the B of A's, the Wells, the Cities, the Chases, the US banks, the Fifth Thirds, and so forth. It's not so much the independent mortgage banks applications that are showing those adjustable rate mortgage loans. I'd say it's more of the the credit unions and the depositories who are out there, and they've got an inside track on some of that product because in many cases they like having ARMs in their portfolio. So it'll be interesting to see how, if the independent mortgage banks can catch up with adjustable rate mortgage production to the banks.
Yeah, and now I think the ARM market's going to come back. And I remember like the late 90s, early 2000s, we were in this similar rate climate, 30-year fixed rates in the mid fives, high fives, and pretty robust ARM secondary market developed. Remember selling a bunch to Dime and WAMU and others that went away or got swallowed up. But it was really competitive. And I think it will be competitive because I think the thing that you've seen with our industry over the last 10 years, especially, is the credit quality has just continued to get better. I think there's a lot of factors, more conservative underwriting criteria in general, people, homeowners and buyers understanding their credit better. And just, I think a lot of the technology that's emerged over the last decade in the mortgage industry, it's weeded out a lot of the bad loans, like fraud for sure, but even, other things on loans that would still make it to the finish line that make them less than perfect credit. I think that, in my opinion, the credit risk part of mortgage, especially with this really, really strong and resilient labor market in America, it's better quality product. And man, if I'm an investor that's buying assets, I love ARMs because, they're fixed for 3, 4, 5 years, 7 in some cases, 1 in some cases. But then you've got an asset that is constantly adjusting to a spread over some sort of index. So it's a great asset for investors, though, if you believe in the credit quality.
Yeah, I agree. The credit quality, well, that's a whole breakout Rich and Rob show discussion about credit quality and whether lenders are sliding down the credit curve again. And I'm not going to have that discussion right now, but yeah, I would agree in general with you, with the ability to repay and the loan to values being what they are, and just borrowers having reserves and certainly at this point equity for refis. I think we're in much better shape. Owners of mortgage-backed securities are in much better shape than 2008, 2010.
Yeah, absolutely. I mean, if I'm an investor, I'm taking the 200 basis point spread on mortgage backs over treasuries right now, because me personally, I'm a believer in just the repay factor. And now you got, a less likelihood of early prepayment because of the rate climate. So we'll see what happens there. But my hope and my guess is that a stronger ARM secondary market develops. A couple comments in the chat. One about the climate change thing, and Bob saying, when will we stop lending on Florida coastal property as oceans rise? It seems to make sense. And our newest member, Tom Sattler, the Equitable Bank out of Wisconsin, 2-to-1 portfolio ARMs versus sold loans in March, and same in April. This is a new member of ours, community bank in Wisconsin, does a good amount of portfolio lending, using that as an advantage of theirs. And then he says, is SOFR the problem with Fannie Freddie not using ARMs? I just don't think Fannie and Freddie are ever going to be viable buyers of adjustable rate product for a bunch of different reasons. Rob, you've been around much longer than me. I don't know your thoughts. I don't know.
Yeah, Rich, during the Eisenhower administration, I don't know if ARMs are their sweet spot either. I don't think they've ever been great adjustable rate buyers. That I don't think they view them necessarily as non-QM, but they view their sweet spot as 30-year and 15-year, and let the arms go elsewhere to the depositories or to private label issues. So yeah, I don't see them like becoming the cutting edge investor outlet for adjustable rate mortgages.
Yeah. A couple other pieces of news this week, more evidence of home buyers relocating away from the high priced areas like where you live, Rob, and to more affordable man of the people areas like where I live. You're continuing to see population migration to lower priced areas. Rents 20% up year over year. Rents just keep going up. No surprise there. Why would they not, with what's going on with home values to buy a house? But looking for some good news, and we've had to dig deep at times these last few months to find good news. Lumber prices at all-time lows for 2022. Are you excited about that, Rob?
Lumber prices are what, all-time highs or lows?
Year 2000 lows for 2022. So still high by relative standards, but the lowest they've been this year. So.
Sorry, big truck was here.
Oh, okay.
Yeah, lumber prices. What are you going to do?
Yeah.
Let's harvest the forest, like that session we had, or you had in Miami with the home builder talking about forest management in the United States. Crazy.
100 trees per acre considered healthy, and according to CEO, the National Home Builders, forests all over America with 300-400 trees per acre, 3 to 4 times the healthy level that I'm not allowed to get into because there's a squirrel in there evidently.
So Rich, you're going to the game tonight, right now. As soon as we hang up, to the board of directors have to approve this. You're leaving kind of early, aren't you, on a Friday? Is that like PTO?
No, it's I will start working early. Honestly, I don't got to get it approved. But,
I approved it.
Amy approved it. Thanks, Amy.
You're free to go.
Did you hear a voice?
This is honestly, I think it's either my 39th or 40th consecutive Indians/Guardians opening day.
Really?
Yeah, I've been to every one since I've been 5 or 6. I don't remember exactly when, but yeah, a tradition. Got my son and one of his buddies and my girlfriend's son. We're heading down to for the festivities shortly here. So
very good, very good. Well, I'll show Gramercy Park again. It's it's nice. It's nice, and anybody who's going to the national conference next month, Times Square, godforsaken Times Square, I recommend getting out of that area a little bit to see what the rest of Manhattan can offer.
Fellow transplanted Clevelander Dave Conway saying go Cavs tonight. Cavs also playing in the playing game against the Hawks. This game scares me tonight. Hawks are starting to roll. Jared Allen 50-50, but we'll see. It's weird for the Cavs. If the Cavs lose, they keep their first round pick because it's lottery protected, which would be good. But if they win, you get playoff experience for a young group that needs it against the Heat, who actually is the matchup I like the best. So we'll see what happens there. Rob, any weekend, how long you in the Big Apple?
I'm here until Monday, and then I go down to Atlanta for a NBA Strathmore peer group session, and then to the Great River Conference toward the end of next week.
That's a great conference. I can't make it this year, but that is one I enjoy. They do a really, really good job with it. It's like 4 states together. It's lots of lenders. Do a good job with it. And it was kind of, I was like MBA Tech this week. Some of the reports were the vendor to lender ratio was a little askew, but So, but the Great River is kind of the opposite. They do a really good job with that. So you're going to be at the Texas MBA?
I'm not. Okay. Are you?
Yeah, I'm going to that one, and then the MARC, the Mid-Atlantic Regional in Maryland, DC, National Harbor, which is good, and then secondary, of course, at the aforementioned Marriott Marquis in Times Square. So, but
All right.
Excellent.
We'll have
Well,
fun tonight at the game.
go Guardians. I decided I'm not going to be one of these angry people that refuses to embrace change, adapt or die. I'm riding with the Guardians. And
Remember, Rich, change is mandatory, but oh my gosh, what's that? Oh my gosh, Tony Robbins. Change is mandatory, but progress is optional. So there you go. All right, there's something pithy to end the week.
poignant note to end the weekend. Yeah. So Rob, enjoy the weekend. To all of our viewers, listeners, thanks for wrapping up the week with us. As always, we'll upload this to our YouTube page and turn it into a podcast that you'll see in the Apple, Spotify podcast feed if you subscribe to TMC Connect on either shortly here. And until next Friday, have a happy Easter weekend and a great next week, everyone. Take care.